what we always recommend is you have a large percentage of your portfolio allocated to the stock market, but what you want to do is slide it up and down in terms of your total allocation. So if your steady state market's kind of a normal valuation, you don't think it's overvalued, you don't think it's undervalued, maybe you're at a 50% allocation, or some people like 8%, right? Depending on your exposure to things like private assets, venture capital, crypto. But if you do have a very diversified portfolio with all those assets, maybe 50% is appropriate to you. And if you think the stock market's a little rich, like today, the valuations are high, you might want to scale that down to 40%. So take off 20% of your allocation to stocks. And now you can use that money to go buy maybe a real estate property or increase your allocation to private equity. Maybe you want to hold more cash. You're de-risking your exposure to equities. And then vice versa, if the stock market is cheap, if we have a situation like 2010, 2009, where after a crash, or even a short couple months ago where we had a 20% fast correction in the stock market in April, maybe you want to bump that allocation up to 60% when your normal allocation would be 50. It's a spectrum. You want to flex it up and down. We're not saying any absolutes. We're not saying go fire sell all your assets because it's expensive. Nobody knows where the market's going. Even if you look at the last 20 years, we've been on a very steep increase. So there's no easy road to investing. So all we can do is look for new opportunities and adjust our allocation and use portfolio management, right? Diversification to try to get the best returns by spreading out our risk over multiple asset classes and not just being 100% exposed to stocks.